Assalamualaikum and hi to my lecturers and all my fellow friends. My name is Nur Najwa Akila binti Zulkafli with metric number 268078. Now I will present the case study 3. I will explain the executive summary. So in general, this case was about an accounting policy decision involving two companies, UPC Berhad and MIM Holdings. UPC owned 100% of this company. So Aina, the accountant for MIM Holding, was the main character in this case. So her company had missed the deadline for producing a 2018 consolidated financial statement for their parent company. UPC MIM is a special purpose entity that was established in 2009 to generate revenue for UPC. The problem began in February 2018 when they began to meet with accountant for UPC's consolidated financial statement and the fund initial recognition resurfaced. So the GA and Associates serve as UPC's external auditor for its financial statement. There are several issues faced by Aina in which some item that she recognized in the financial statement was seen differently by the external auditor of UPC Berhad. The issue is getting analyzed and solved by providing several alternatives to ensure the presentation meets the accounting standard. Now I will present the statement of problem. For the issue 1, the control power of UPC Berhad to MIM Holding, whether it is appropriate for UPC Berhad to exercise its power to their subsidiary company. So the issue started in 2017 where a new investment opportunity outside the Klang Valley arose, an opportunity that might help MIM to achieve its objective to generate more income to UPC. The parent aggressively pushed for MIM to snap this investment. It exercised its control over MIM in acquiring the investment. It appeared to be a golden ticket given that the selling price was attractive and below its fair value, an opportunity that might help MIM achieve its objective to generate more income for UPCs. And then for the second issue is the recognition of the fund, whether the injected fund need to be recognized as equity or liability. So this issue started when the fund had flowed in MIM Berhad in 2017 to the amount of 18 million and had been utilized for the investment. When the cash flowed in, Aina felt relieved that the investment could proceed. To MIM, it was cash pumped by the parent to support a subsidiary's performance and generate future income for the parent. The external auditor for MIM, which is MJ and Associate, had then advised Aina that the fund should be recognized as equity, since UPC is the parent of MIM. And then the last issue, the third issue, is solvency of MIM Holdings, whether the company issued the RCCPs is solvent. So RCCP are preference shares that provide for mandatory redemption by the issuer for a fixed or determinable amount at a fixed or determinable future date, or give the holders the right to require the issuer to redeem the instrument at or after a particular date for a fixed or determinable amount. It should be classified as a financial liability. However, for a redemption of preference share to occur, a company would have to prove its solvency under the Companies Act 2006. Now, I will present the cause of the problem. For the first issue is the control power of UPC Berhad to MIM Holdings. The causes is the parent company own 100% of the subsidiaries company. So this problem is because UPC Berhad exercised its control over MIM into acquiring the investment. So based on MFRS 10, UPC Berhad would have the power over the MIM, which UPC has existing right that give it the ability to direct the relevant activities. Besides, UPC Berhad also has the exposure or right to variable return from its involvement with MIM. UPC Berhad has the ability to use its power over MIM to affect the number of the UPC's return. For the cause of the problem for the second issue is the recognition of the fund. The cause of this problem is the external auditor of UPC Berhad saw the fund differently from what it has been having recognized. So the parent was adamant about not recognizing the injection of fund as an additional capital contribution. It arose from the desire to reduce MIM's financial reliance on the parent. So UPC's board of directors was only willing to offer MIM a short-term financing arrangement. So they believed that MIM would be able to repay the fund injection from the investment return. So MIM was devastated by the fact that it now had to recognize not only the 40 million Islamic banking loan but also an additional liability of 18 million. The last cause of the problem is the solvency of MIM holdings. So the cause of this problem is the issuance of redeemable convertible cumulative preference share RCCP by MIM holdings. So preference shares can now be redeemed out of the capital of the company under Section 72 sub 4 of the Companies Act 2016. For a redemption of preference share to occur, a company would have to prove its solvency under the Companies Act 2016. So under the Section 112 sub 2 of the Companies Act, a company should be deemed to be solvent if it is able to continue to meet its debt as and when the debt become due without any substantial dispositions of its asset outside the ordinary course of its business, restructuring its debt, externally forced revision of its operations or other similar actions, and the capital of a company shall be deemed to be impaired when the 9 values of its net asset is less than the aggregate amount of all the shares of the company after the share buyback. Now, I will present the decision and alternative for the first issue. The first alternative is MFRS 10. So, based on the case, MIM Holding should apply MFRS 10. So, according to MFRS 10, consolidated financial statement introduced a single control model to identify a parent-subsidiary relationship. So, the new control model is a qualitative model based on the 3 elements of power, returns, and link between power and returns. An investee may be identified as a subsidiary even if the investor holds a little or no equity interest in the investee. For the second issue, the first alternative is this fund should be recognized as equity. So it was certainly not the first time that the parent had done so. So based on the case, a financial instrument is an equity instrument only if the instrument includes no contractual obligation to deliver cash or another financial asset to another entity, and if the instrument will or may be settled in the issuer's own equity instrument, it is either a non-derivative that includes no contractual obligation for the issuer to deliver a variable number of its own equity instrument, or a derivative that will be settled only by the issuer exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instrument. For the second alternative is the fund should be recognized as liability. As stated in the case, UPC agreed to fund the balance by injecting the 18 million, but the board of directors of UPC was only willing to offer a short-term financing arrangement to MIM. So, based on the discussion paper, the classification principle of liability contained an unavoidable contractual obligation to transfer cash or another financial asset at a specified time other than at liquidation, or an unavoidable contractual obligation for an amount independent of the entity's available economic resources. So related to the case, UPC Berhad agreed to fund the balance by injecting the 18 million, which they considered as short-term financing, to MIM Holdings. For the third issue, so the first alternative for the third issue is run a quick test for the ratio analysis of solvency. So ratio analysis is a cornerstone of fundamental equity analysis. In general, a solvency ratio measures the size of a company's profitability and compares it to its obligation. Otherwise, the debt-to-asset ratio measures its assets financed by liabilities, which is debt, rather than its equity. This ratio can be used to measure a company's growth to its acquired asset over time. So, by interpreting a solvency ratio, an analyst or investor can gain insight into how likely a company will be to continue meeting its debt obligation. So, a stronger or higher ratio indicates financial strength. For the second alternative for the third issue is refer to the characteristic of the solvent company in Company Act 2016. So according to the Companies Act 2016, Section 112 sub 2 state that for the purpose of share buyback, the Section 112 sub 3, a company shall be deemed to be solvent if it is able to continue to meet its debt as and when the debt become due without an substantial disposition of its asset outside the ordinary course of its business, restructuring its debt, externally forced revision of its operations, or other similar action, and the capital of a company shall be deemed to be impaired when the value of its net asset is less than the aggregate amount of all the shares of the company after the share buyback. Now, for the last part, I will present for the recommendation. The recommendation for the first issue is the control power of UPC Berhad to MIM Holdings. So, based on the discussion of the alternative solution mentioned in the previous section, we suggest that UPC Berhad should follow MFRS Consolidated Financial Statement. This is because as a parent, UPC would have the power over MIM. For example, UPC has existing right that give it the ability to direct the relevant activities which significantly affect the MIM's return. So UPC Berhad has exposure or right to variable return from its involvement with MIM and the ability to use its power over MIM to affect the number of UPC's return. Then, MIM Holdings should ensure and care about their staff, since the staff did not fully understand the internal control mechanism, and management also did not put emphasis on the actual implementations of the internal controls. The recommendation for the second issue is the recognition of the fund. So the best alternative solution in this issue is the fund should be recognized as a liability, because every fund is a self-balancing collection of accounts. So as a result, amount owed to or from other funds are typically the result of the inter-fund loans or inter-fund services provided between funds. For example, one fund may make a loan to another fund, or one fund may provide services to another without receiving payment at the time the services are rendered. Funds receivable and liabilities can be classified as current or non-current depending on the terms of repayment, but all such transactions must be recorded as fund receivable and liabilities. The advancing fund should set aside fund to cover the non-current portions of amount owed to another fund. This is also because according to IAS 32 financial instrument presentation established principle for distinguishing financial liabilities from equity instrument. It applies to the classification of financial instrument as financial asset, financial liabilities, or equity instrument. Now I will present the recommendation for third issue is solvency of MIM holdings. So this shows the calculation of debt of asset ratio. Based on the debt to asset ratio, it has been calculated that MIM holding has 0.802 for 2019 and 0.774 for 2018. It has been shown that the company does not have a good debt to asset ratio. It also indicates the ratio of asset finance with debt. So the higher the leverage and financial risk, the higher the ratio. So the MIM holding have the higher leverage and financial risk, and with this calculation, it can help MIM holding to have a clear picture about their company solvency. So that's all from me. Thank you.